Hello traders, welcome back to another video, and in this video, in this diary entry for today, I'll be talking about how to boost your trading accuracy. So everyone would like to boost their accuracy, I'm sure, and to lower the number of losing trades and increase the number of winning trades. And today I'll show you how I do that by combining the indicators and the usual trade rules with the market structure, and the market structure is all important. And if you don't know what market structure is, then I'll be showing you here. So let's go over what I'll cover. So these are the ways to improve your edge, to boost the probability. So there's obviously the more confluences you have, the more points that indicate that the trade is going to go in your direction, then the better, the higher the probability, and we're going to use market structure to increase that probability. And always remember not to depend on indicators alone. For trading, indicators are just that, they indicate something, they do not tell you what's happening. And following market structure, which we'll go over, and then combining the two for a better setup to improve your edge. So we will focus on market structure now, and we will combine that with the indicators and the other rules, and we will actually create, we will show you how to avoid those losing trades. And perhaps it will give you some context as to why you've lost some of your trades, and you can go back and see if the reason that you've lost some of your trades is because you haven't looked at market structure. So let's just go over what the concept of this market structure is when you place a trade. So the structure. What is the structure? The market has a structure where it moves in trends and swings, not always precisely, of course, but when it does move in a trend, it generally moves in a particular structure where it has a sort of channel, and within that long-term trending channel we have the pullbacks, which are themselves channels, and then we have the continuations, and again the same. So within these channels we will have another trend, and the market will reverse, and another pullback trend. So we have a trend within a trend. So of course within this pullback, since it's all fractal, we will have the market trending up when we zoom into the picture within. And then the market will, at some point, it will stop trending, then it will begin to reverse and trade higher, and then at that point we will have again the same thing repeating. We'll have again a new trend develop, and again we will have these kind of channels within the market, and then we will have the same structure but in reverse happening. Of course, it's never It never looks perfect. It's always an approximate type of style, but this is the structure that the market takes on when it moves. Here we will have a smaller pullback, so a smaller trend within the structure before the market continues. It doesn't always pull back exactly to these channels, to these trend lines. So we need to bear that in mind as well. But we have a structure forming. So what does all this mean, and how can you use it to your advantage? Well, if let's say that you have a trade where you have identified that the market is in an uptrend, here, and you looked at a small time frame and you identified a pullback here. Let's just make it more clear. So let's zoom in and we pretend that we have looked at, we are looking at this trend here, and we are focusing on, we'll just make it in a color that stands out. Let's say we are focusing on this trend here, and we've identified an entry right here, and we want the market to go higher because that's how we will realize our profit. So if you take this trade and then you will see that the market begins to stall or that begins to reverse, many times if you actually look at the market structure on the bigger picture and you zoom out, you will notice that the market is reversed because the market is in a structure which is actually part of a bigger picture. It's part of this structure, and therefore it makes sense that the market reversed, and it makes sense that this trade didn't work out. So the higher time frame structure will always be the dominant trade direction, and you should always be wary when you trade, whenever you trade with your rules, that it fits in line with the structure. So where would actually be the best place to take a trade? Of course, it would either be here, if you can identify it, to go up, to buy, or it would be here or here as the next point when it's time to go down or sell. And if you can identify that the market is in this structure on a higher time frame, and then take your entry once you've identified that on a lower time frame, you will have the best possible entry within the market structure. So this structure will show you that bigger picture. So instead of being focused on this and being completely absorbed by what you're seeing in this picture, you can zoom out and actually notice what's really happening on the bigger picture and where you are in context with the whole structure of the market. If you are here at this stage where you see the market is ranging, then perhaps you may want to consider not taking a trade at all, because the market is no longer trending and it's no longer in the structure, and it's now has stalled, and we don't know whether it's going to continue or whether it's going to create a new structure and go up. Now this happens again, as I've said in previous videos, in a fractal nature, so it can happen on any time frame. So we need to identify accurately what the structure of the market is on a higher time frame, and where we are in that structure. Once we've done that, then we can identify the lower time frame and we can better see where we're at, and then we can place a trade to make sure that we're not moving in resistance to the higher time frame structure, the overall structure of the market. So let's see how that looks like on a chart and how we can apply it now that we have this concept. Of course, the same thing works in reverse. So we want to identify those structures and be in line with them. So let's look at a chart now. Okay, so I'm going to use this example of the Aussie yen chart, and on this occasion what I will be using is the daily chart as the entry. So let's go over what the picture looks like if you only look at the time frame without the actual market structure in place. So perhaps you will have EMAs. We'll put in a popular one, which is 50. Perhaps you will have, if in our tools here, with the tools on the side that we can see, perhaps you will mark out a trend line. Perhaps you will have a fib level drawn. So we are going to just pretend that this is where we're at. I'll put a vertical line here. So in this occasion we have here a market that came into the 50% fib retracement. We have what looks like a pin bar. Perhaps you might want to trade it long. You also have this support resistance. You had another pin bar here, which you may have wanted to trade to buy, and together with a trend line, and the market is bouncing on the EMA, whatever your rule is, whatever your parameters are for placing the trade. And you would have looked at placing this as a buy to go up, and you would have been trading up. So then we have what looks like many valid confluences, many valid reasons to take the trade. However, if this was our trade, this pin bar or this pin bar, and that was our reason, why is the market not doing that? Why has it now stalled? And you can in fact see that the candles that are now printing do not indicate that we are correct. They actually show a failure. Now, why is the market ultimately failed here? Well, what we need to do is we need to zoom out. So this trade was a loss, and this could have been any time frame. So any time frame that you were trading, you could just apply it here. It doesn't matter that this is 1 day. We're just going to use this one in this case. So what's happening here? The market obviously failed. So it seems like all the confluences were there, all the reasons to take a trade were there. But it did not happen. That did not happen. So why don't we go up? We go up a time frame and we see what's actually happening. So let's just delete these. Let's just get rid of some of this. We can see that this, where this crossover point is, that was where our trade was. Just remove the EMA as well, and let's go into the monthly and let's see if we can get a bigger picture idea of what's actually happening. So what we can see in this case is, let's go back to our indicators. Let's go into, and let's, using the trend line, we will just draw the market structure in place. So we have a structure here, and you can see that. Let's just delete that one. I want the trend line, so you can see the market had a structure in here. Then it went up again. And then here, this is where the reversal began. And we began to have another structure in place. Let's just make this a little bit more accurate. Here we have the downward impulse move structure. Then we have the retracement structure. Once again, the impulse move. And now the market is in a very sharp correction on the higher time frame. So if we now zoom in, after drawing all this complex structure picture, what we end up with is we can actually see that overall the market is right now in a downward structure, a downward trend on the higher time frame, and in fact it is now in a correction mode, and we are coming up against this larger picture structure, and we can see that it's actually sitting against a higher time frame trend line structure, and therefore we can expect that the market will reverse at this point somewhere here. So we do not want at this point to be buying, to go up. At this point here would have been okay, or here, that would have been fine. But here it is now becoming riskier. The probabilities are no longer in your favor, and the edge is going to be reduced. So the best thing to do here is just to stay out, and that will reduce your number of your losses and improve your accuracy. And the best thing to do would be to wait. Now that we have this structure, would be to wait, of course, until you have a new structure forming to the downside. And once you have confirmed that new structure, then you can take the trade down. You can go down. But definitely not up. It is now in a point of reversal, and we can actually see that on a larger time frame. If we ignore all of these, we can actually see that we have a point of a zone here of interest, of support resistance, a key zone over a very, very long period since 2004. So in fact, there's more than one reason, not only the structure. But here, the structure plays into effect very, very clearly. So what we want to do is, we talked about using the indicators. So we had all the indicators on the daily showing us a pretty good reason to take a trade. However, it failed. And it failed here when the market went lower, and it would not have failed if we just zoomed out and saw the bigger picture and saw that structure, and then we would have known that this is not a good place to take a trade. So the market structure has a very, very, very important factor to play when you're entering. It gives you the bigger picture, it gives you a context of where you're at with the trade. So how do we include our indicators, include our trades when we are aware of this structure? So what we can do is, as I said, I would wait for this structure to start forming, for it to come back down and create a new structure here. So let's just remove these lines for a moment. Just clean up the chart. Let's just get rid of everything. So now that we know that, we're going to wait for a new structure to come into play. I don't know how that's going to look like, but we're going to wait for that. So now that we know that, when that happens, however it happens, what we're going to do is we're going to very simply wait for that to form, wait for that to happen. However it looks like, we don't know, but let's just say it looks something like this. What we will want is the market to come down, retrace again, create this structure within a structure. Then perhaps we will have our fib levels, you will have your horizontal levels, and then you may also have your, let's say, RSI, which will confirm your trade, and then you will have a point of confluence, so all your indicators will show that, but the market structure will add to that, and then you will know that, let's say somewhere here, 61 fib, we have this horizontal level, and this will be the place to go short, to go down, and that will be your trade. So when you have all those factors, your usual rules for your trade combined with that structure, that's where you will have a very accurate, a very highly probable trade. And that is how you use market structure. So I hope it helps you. I hope you improve your trading and have more accuracy, and this will help you to reduce your losses and improve your trading. Thank you, and see you on the next diary entry.